joining the Real Estate Investors Network today. I'm Candice Harris with Save Modern Realty, and we're here to answer your questions about investing in real estate. Today, we have a guest, Jim Hopkins. I'm going to let him introduce himself.
Thank you very much, Candice. Thank you for having me on. My name is Jim Hopkins. I'm the SVP for Cardinal Financial, which is a traditional lender. And then I'm also the owner of a hard money company or a private lending company called EPC Ventures.
Okay, thank you. So, as you know, we always have questions from for the people who watch videos, people who looking to invest, investors, experienced investors. So today's question is, what are the requirements for financing an investment property? And also, what are the different options?
That's a great question. And even in this environment where rates are going up and people are talking about price appreciation or depreciation, it's still a really good time to look for investment properties. If you look at multimillionaires and billionaires across the industry, they all have a sizable chunk of a real estate portfolio that's a sizable chunk of their net worth.
Yes.
So I'll break it down into really two different sections. Because I work on both the traditional side and private lending side, I have a little bit of a different perspective of this. So for an investment property on the traditional side, which is, when I say traditional, what I'm talking about is what most people think of. Hey, I saw this house down the street. I think it'd be a great rental property. I want to buy it and rent it out, right? How most people think. Really, the requirements are pretty simple, right? You've got to have good credit, 680 or above. And really then it just comes down into your down payment. Sometime in late 2021, the government changed the rules for investment properties because rates had dropped so low and so many people were buying investment properties that they really kind of dialed up like the pricing, and that's why you hear about rates on investment properties going up so much. They thought they were subsidizing it, so they put a lot of points and penalties in there now that we're all feeling the effect of.
Yes.
But really, when it comes down to down payments, you really have three options. You can go with the lowest down payment, which is 15%, and then it goes 20% and 25%.
And that's based on your credit score, or?
Well, no, not really. That's really what all that's going to do is it's going to be where your brakes are for your rate. So a lot of people will call and say, well, how do I get a better rate? Do I get a better rate? And when you talk about like your primary residence, for the most part, putting more money down, for the most part, not in all instances, doesn't really get you a better rate. It's just it lowers your monthly payment.
Okay.
Investment property, that's not true. The more money you put down, the better set of terms you're going to get, both in rates and in points and fees that are charged. So I'll do the big reveal up front for all of our viewers. It makes more money. It makes more sense to put more money down, right? Don't do the 15% option unless you just don't have the money to put down.
Yes. And a lot of people are looking for ways not to put money down.
Yeah.
But that's another.
And that's, once again, that's fine. The payoff though is substantial. And what I mean by that is that the difference between, forget the dollar amount, the difference between 25% and 15%, maybe 10% down, obviously, which is a lot of money, but the amount of points that you pay may be 3 or 4 points extra.
Right.
And so, heck, at that, at that point, no pun intended, you're literally just giving money away that could be going towards equity. So what I would tell you is, yes, unless you just got a deal you can't pass up on, save a little bit more money, put a larger down payment down, because you will 100% reap the return on that investment.
Okay. Great. I know some people don't want to hear that, but that's the truth.
Yeah, and like I said, and we talked a little bit about it earlier before we started rolling. A lot of investors, so private money or hard money isn't as scary as it used to be. It used to be, that was like, oh, this is this voodoo financing. I don't want to touch
it.
But
it does that.
But now everybody wants to be a fix and flipper. Everybody wants to buy investment properties. It's not like it used to be where only, okay, I'll never own this or I'll never do this. People are doing it as a hobby. If you've got access to a good private money guy, man, there are some more sophisticated but there are way better options out there that could potentially save you a lot more money if you can buy right by going the private money route.
Right. And I know we were talking about a scenario to where I have clients who will use hard money or private money up front and then turn around and refinance to a conventional loan.
Yeah, I'm seeing that more and more. In fact, when I got into the private lending space or the hard money space, a long time ago, almost all of it was exclusively like fix and flip, which is where you're buying and I need the financing to repair it. But as people have gotten more sophisticated and candidly, as they've gotten more tools to buy properties that are distressed sale type properties like foreclosures or estates or something like that, where the house may not need any actual repairs, but they're able to buy it under market, right? And that's the key. That's the key to making it work, is being able to have either to identify a property or have a realtor who can identify the property for you under market. That's where it's going. And
yes, definitely.
And the way,
and that's where a lot of people kind of see themselves in the red because they don't put the numbers together to make sure that they account for holding costs. And things of that nature. Of course, your payments on your loan, and then they get into the red, go over budget for the rehab, but you got to account for all of those things up front.
Absolutely. So. And I always tell people, like, I get people who, when they're talking to me about their first investment property, especially on a fix and flip, they want to talk about how cheap they're going to get the repairs done. And I try to explain to them, like, man, the profit on this house is made on the purchase. If you don't buy it right, I mean, yeah, you may cut a little bit off your repairs, but you're not. That's not where you make your money. You make your money on buying it right. And I think a lot of people, to your point, they figure that out very late in the game. Right. And it's sad because, like, I try to have this conversation and you'll point it out, but a lot of people, they'll just keep looking around for someone to tell them what they want to hear. And there are plenty of lenders who are more than happy to lend you money because they don't care. Right.
And that's what I love about you, because you would tell me the truth and you will let me know all the information up front. So I really appreciate that.
Absolutely. Yeah. I mean, I'll talk a little bit about how people are using private lending as an alternative to traditional lending. If you're good with that.
Yes.
And I'll give you two different scenarios and why in certain instances it makes way more sense to do private lending for even what you would consider a traditional rental property. And it really boils down to the guidelines for traditional lending, so a traditional Fannie Freddie loan. And what happens is that all those guidelines are based on your acquisition price, right? The value of the property never enters into the equation. They don't care that you're buying a $400,000 house for $200,000.
Right.
All they look at is that sales price. So in a traditional loan, using the example that we talked about earlier, I'll use 25% because the math is easy to figure out for me.
Okay.
If you were buying a $200,000 house that was worth $400,000, and yes, I know that's a really kind of silly scenario, but I'm trying to illustrate a point. You're going to put down $50,000 as your down payment. And then let's just say you have, just to have a good talking point, let's say you've got $5,000 in closing costs, right? So you're going to be into that loan and that purchase for $55,000. Right? Now, you take that same scenario, you go to a traditional lender, a private lender. And what I look at is I say, well, look, if you're buying this house, if it's worth, my appraiser says it's worth $400,000 and you're paying $200,000, I don't need any money down.
Right.
And because you want to buy the house, right? You don't care about like you want the sausage. You don't care how it's made.
Right. Exactly. Exactly. So thank you so much on the different options. Let me ask you this: if you were buying an investment property for the first time, now knowing what you know now, what way would you go?
The first thing I would do is I would make sure that I had a realtor who was very knowledgeable about what I was doing, and I'm not ripping on anybody in particular or anything like that, but make sure that the realtor that you are talking to deals with investors.
Yes, they have experience with investment properties, definitely.
Yeah, because it really is a different animal. There's a whole different set of underwriting guidelines that go to it in terms of, we talked about qualifications, but once you start adding properties to your portfolio, you've got higher net worth requirements, you've got higher reserve requirements, things like that. And there are a lot of little subtle things, more than we have time to talk about on this episode. But you want somebody who knows who can guide you for that after you close. Do you put it in the name of an LLC? Do you put it in the name of a trust? You want somebody who knows there, or if they don't know, they know someone who does know. Right,
and they have the resources, like you said, to provide you what you need.
Correct. And the other thing is that I will tell you that is because you want to. What I would do is I would surround myself with people who know more than you do.
Yes.
Because they're going to keep you from making the mistakes that you don't even know you're making. I've and like I said, we could go through countless horror stories, but same thing with your title company. Make sure you get a title company who knows what they're doing. Great deals usually have some type of title issue.
Yes, and title companies who work with investors.
Absolutely.
Because not all of them do.
That is correct. There are a lot of title companies who don't want them.
Right.
They will politely tell you, hey, this isn't. I mean, I get it, right? Because investment transactions can be difficult on the title side, especially if there's heirs and stuff like that. But first thing I would do is surround myself with the people that I would know, and then I would go to a lender and get pre-approved first. And I know that sounds so
pre-approved for what? For just conventional?
I would talk to someone talk to your realtor. Your realtor should be able to put you in touch with someone who does both, and then compare the options, right? I would definitely get pre-approved. You're going to have to get a traditional loan no matter what, because you don't want to keep a private loan for very long.
Right.
So get pre-approved for that. And then I would look at the private lending side now that I know what I know. And and once again, only look at the private lending side if you are buying under market, right? If you're buying at market or just maybe a little bit below, really traditional is going to be your best route.
Right.
And for most people, there are a host of reasons why it may not be, but for most people, that's still going to be your best option. And then the number one thing that I would tell new people is be prepared to move quickly,
definitely
know the area, know to a T what you were looking for. And if a deal climbs up or if a deal pops up, execute immediately.
Yes.
I have bought multiple houses sight unseen, where I've seen them on HAR, but I'd hear offers in. I haven't even toured the house.
But you know those numbers.
I know, because guys, it's not about whether you really like the paint color or the bathtub.
Right.
It's all about the numbers, right?
About the numbers.
And so if the numbers add up, man, you can, during your option period, you can figure out everything else.
Right.
Get the property under contract. And so as soon as there's things that time, there's a saying, time kills all deals. And I have to sit back because, like I said, this is what you and I do for a living, right? So this is old hat for us, but for new people, well, I'm going to think about it, or we're going to meet this weekend. I'm like, you already lost the deal,
right? Because if it's that good of a deal, then you have 20 other people trying to get.
Yes, because once again, this isn't something that is a secret anymore, right? Home and Garden TV ruined it for everybody.
Right. And everybody thinks it's easy.
Everybody thinks it's easy. Everybody, look, here's a news flash. You cannot remodel a house in 30 minutes. No. And look, if she's wearing that much makeup and she doesn't have dirt on her shirt, I guarantee you she's never swung a hammer. Do not
do that.
That's not how that works. Yeah, everyone is not going to be Joanna and Chip Gaines. It just doesn't work like that.
Not at all.
And that's the problem is that everybody, you have a bunch of new people coming in who they're overpaying for properties and stuff like that.
Yes.
And then, like I said, so what I guess the final thing is that, be prepared to move fast, but know your numbers, and your numbers are your numbers.
Yes.
Don't get caught up in the emotion of the deal.
Yes. And like I always say, stay on budget as much as possible. I know things catch you off guard, things pop up on the house or whatever, but you definitely want to try your best to stay on budget. And prepare for that.
Absolutely. Things are going to go wrong. Have a, you know, an oops factor that's in there. But then, I mean, like I said, stick with your numbers, and $1 too much is $1 too much. And a lot of people will start talking to themselves and say, well, it's only a little bit more. It's only a little bit more. Well, man, if you start making that compromise very early in the process, it will cascade into compromises throughout the process, and you will wind up either breaking even or even worse, losing money. And like I said, I've dealt with you personally on some loans. In fact, Candice actually bought my dad's house.
Yay!
So, I mean, that's how much I trust her. I actually called her and sold her my dad's house. And I know the game. I know how it works. And, you know, I've been with you on other deals, and there's a number where it makes sense, and there's a number where this is what I need to make, and that's okay, right? Profit is not a dirty word. None of you are doing this for charity,
right? Nobody's working for free.
Nobody's working for free, and people will go, well, if I make this, I see this a lot. Well, people will go, well, if I'm making 10 grand, that's a ton of money, and I'm like, yeah, it is, right? If I found 10 grand on the street, I'd be like, this is fantastic,
right?
But I don't think people understand how wildly bad it can go, where if you're starting off with this much profit, your margin for error is this much then. And so, I mean, your one messed up AC,
yes,
one
bad roof,
one bad roof, or hey, one irritated inspector,
yes,
who comes in and decides that, hey, I don't like the way the electrical looks, yeah, but guess what? Replace it all. You're only one. Like I said, it can go bad quick, and that's not. I don't want to scare people off because I love it. I think everybody should do it.
Yes.
Just go into it with eyes wide open, and be prepared to know that it's not. You know, you can't go in blindly. You've got to do your homework
and have the right people on your team that
Absolutely.
Actually have the knowledge.
I mean, look, I've been doing this for 28 years.
I thought you were only like 30 years old.
I started in the womb. I was closing deals. I came out with a contract in my hand. But I mean, the single best source of information even for me, right, is realtors. I call my close circle of realtors who I think hey, these guys are competent. And I'm like, hey, who are you doing this with? What are you doing with this? Have you seen this? Because no one of us is as smart as all of us.
Right. And as realtors, we're always in the market. We're selling,
Absolutely.
Buying, we're in the market. We have to keep up to date, just as you have to keep up to date with the rates. And we'll talk about that too, because we were talking about that earlier. But keeping up with the trends of the market and what's going on.
Yep. But here, so we're going to have rates are going up, and it's not a direct correlation to mortgage rates. To some extent, actually, after the announcement, mortgage rates may come back down because they're pricing in kind of this anticipation of the rates going up. So it's not uncommon for rates to actually come back down. But here's what I will tell you is that one of the reasons why mortgages are so expensive right now is it's not just the rate, it's the amount of points you're having to pay. Historically, on traditional loans, like nobody paid points.
Right.
Now it is very common.
Right.
I'm not saying it's on every deal, but it's more common than not, and it's more common than not to see more than a point. But Fannie Mae and Freddie Mac, part of the reason that's happening, and for those people who don't know, Fannie Mae and Freddie Mac are the two largest aggregators of loans in the country. So almost every loan goes through them, virtually every loan. They do not believe that rates are going to stay this high for very long.
Okay.
And there's a lot of really good arguments that say that's true, but they've actually put their money where their mouth is. And so they're not they're not what's called buying up the premiums, meaning they're not paying for loans that are at these higher coupons because they believe that sometime within the next 12 to, let's call it 15 months, just to give myself some cushion, they believe that rates are going to come back down.
Okay.
And when rates come back down, causes everybody to refinance, and they don't want to have all these loans that they've paid people for that they then have to, give the money back on, right? That they eat it. And so if, don't freak out right now if you look at these rates and go, I'm not going to buy a house because these rates, man, if you can find the rate the rate's the smallest part of the equation. Don't get me wrong, it's important, right? Because it is your payment.
Right.
But houses aren't going back to $45,000.
That's what I keep telling people.
I mean, it's if you even after like the '08 correction, right? And I lived through '08, and I mean, it was bad in Texas, in Houston in particular, right? Barring like the '80s where they had like a massive correction, and that took a long time, right, to come back from. But guess what? Still higher than they were.
Right.
And I don't think people ask me on a regular basis, do I think there's a crash coming? No. Unequivocally, no.
There's just shifts in the market as usual.
Yeah, you're going to have shifts in the market. You may not see the appreciation, tick, tick, tick like it has, but
it didn't tick, soar.
Yeah, that's a good point. So there wasn't a ratchet. It's like more like a rocket than a ratchet. I don't think you'll see that. I think it's going to flatline or hold steady for a little bit, but you aren't going to see houses suddenly fall in value by 10, 15,
right.
20%. You will see that, and someone asked me about this. Someone actually called me out on this. Said, well, what do you look at all these price decreases that are happening? There's a 5%, not the same thing. What was happening was people were pricing in a premium, right? So a house that was $400,000, everyone was like, have you ever been to like one of those koi ponds and like you throw something in, all the fish are doing this?
Yes, yeah.
That was the housing market, right?
Right.
So
everybody's overpaying.
Everyone was overpaying.
Asking
So,
price.
man, we had people who were going in and would tell me, I'm just going to list it at this and see if I get it. And they get it.
And they get it. Or
And they
more.
get it because nobody wanted to miss out. And so what was happening was, so when you're seeing these decreases, it's not necessarily that, oh my gosh, the market's correcting. It's that, hey, you should have been priced here to begin with, and you had this frothy premium built in, but now you're pricing here, and now you're getting back to here. So
right.
You're not seeing. I would argue that the decreases that you're seeing aren't what people think they're seeing, right? That they're not. It's not necessarily a retraction. Like people think, like, oh, the market's
it's
crazy.
more
It's
stabling out and not
stabilizing.
being as crazy as
Absolutely.
it was. But you're not going to get that heavy discount on a property next year.
Absolutely. No, for those of you who are watching who are thinking, hey, I'm going to wake up next year and prices are going to be down 15, 20%.
Because the people who thought that last year had a big wake-up call, and the people who thought that the year before had a big wake-up call. So.
I mean, because look, the only thing that makes the reason that happens when you see big drops like that is because there's panic selling that's going on.
Right.
And we were talking about this earlier. I forget the exact number, so I'm sure I'm going to say this and someone's going to pop up and go, that's not accurate. So bear with me. It's something like, I read a statistic not too terribly long ago that it was like 80% or some really, really large number of the houses in the U.S. are financed with a fixed rate below 4%, right? So you've got people with unbelievably low payments right now. Mm-hmm. They've got a ton of equity in their houses because, guys, I mean, property values have shot up a lot, right? So even if you did have a 10% reduction, right, which would be a pretty big reduction, even a 15%, you're still going to be back.
Because people bought new construction homes and they waited till they were built 4 or 6 months. They got a lot of equity just bought a brand new home.
So you got low rates so they don't have to move because their payments are not on ARMs. Like that was one of the big things in '08 was that everybody was on these crazy ARMs that were resetting. These are all fixed loans. You've got built-in equity in the house, so nobody's underwater, right? So it's not like I'm walking away from an asset that I'm not making money on. Most importantly, everybody's employed, right? So they can keep making their payments. So you're not going to get that panic sale of everyone's out of work, the rates are crazy, there's no liquidity. It's just not going to be like that.
Right. Okay, well, thank you so much. You share a lot of information with us, and we appreciate it. And I just want to make sure everyone is able to get in contact with you.
Sure.
So what is the best contact information if they have any questions about lending or want a private loan, hard money, or even a conventional FHA loan? Jim does it all. So
yeah, you can obviously call Candice. No,
yes.
Call Candice. Give you a discount for using Candice.
Yes.
You can call, probably the best way to get hold of me, honestly, is my cell phone.
Okay.
But you can call me on my cell phone, 713-298-5800. 4663, which ironically spells home.
All right.
Because that's how old I am. You used to be able to get to pick your cell phone number.
And he picked home.
I did. I was selling real estate back then.
Yes. So thank you so much for joining us. And we'll probably have you to come back out because I'm sure we'll have more questions about lending. And thank you guys today. And remember, you can get in contact with me at info@candiceharris.com. Please like and subscribe our YouTube video. Thank you and God bless.
Make sure you follow us
On our YouTube channel, the Real Estate Investors Network. Like and subscribe.
Yeah, make sure you follow us.